Welcome to lecture number 23. In this lecture we shall discuss about leverage ratio. In this section, we shall calculate the leverage ratios from the financial statements of the borrower. In case of leverage ratios, we find out how much the company has borrowed from outside as compared to its own funds in the business. Leverage ratio is given by the formula, outside borrowing of the company, divided by borrowers or promoters' own funds. Please note the following. 1. Generally, a borrower has to invest some money from his own before a bank or other debt lender lends him money. 2. The term leverage determines how the borrower is leveraging its own funds to raise funds from outside. 3. The composition of outside borrowing would depend on the nature of borrowing that we consider for calculation of leverage. We shall look at this in details in the following slides. This slide and the following slides we shall perform the analysis of the financial statement and uncover leverage ratio analysis in steps. For calculating leverage ratio, we have to concentrate on the borrowing part of the balance sheet. Since outside borrowing is a liability for the business, we'll now be concentrating on the liability side of the balance sheet. Please refer to the sample balance sheet of a company. From the balance sheet, the liability of a borrower can be segregated into two parts. 1. Borrower's own funds. 2. Borrowed funds. The borrower's own funds consist of A. Capital invested or equity. B. Reserves. C. Surplus. D. Unsecured loan under some special circumstances, as quasi equity. Borrower's own funds are also called net worth of the borrower. We shall understand the above in the following slides. Let us understand the concept of the borrower's own funds. To understand complete implication of the borrower's own fund, we need to know the terms net worth, NW, tangible net worth, TNW, and adjusted tangible net worth, ATNW. Net worth of the borrower means or implies the amount of funds the borrower, or promoter or shareholder of the company have invested in the business. This is calculated by using the following formula. Net worth equals capital plus reserves plus surplus. Please note, the borrower or the owner or promoter's net worth is the liability of the business. In the understanding of the borrower's own funds, we shall now look at the concept of TNW and ATNW. Let us look at the relationship among net worth, tangible net worth, and adjusted tangible net worth. Tangible net worth or TNW implies the amount of borrower's own funds which is deployed by the company in tangible assets. There would be some assets which are not tangible in nature like goodwill, patent, miscellaneous expenditure, etc. The formula for TNW is TNW equals NW minus revaluation reserve minus intangible assets. The banker would be concerned about any misuse of its funds, so it is interested in finding out the actual amount of funds deployed by the borrower in the present business. The banker, therefore, uses the adjusted tangible net worth, ATNW. The bankers calculate ATNW as TNW less investment in group companies less loans and advances to group companies less any other unrelated investments, plus unsecured loans, verified as quasi equity. The banker's interest is in finding out the borrower's own funds invested only in the present business. Let us look at the quasi-equity classification. Quasi-equity means like equity but not actual equity. Sometimes, promoters bring in their own money in the form of unsecured loan to their business entity as withdrawal of unsecured loan is easier. Generally, the following methodology is followed for classification of unsecured loan as quasi-equity. Borrower, or the unsecured lender, will give a declaration that it would not withdraw the funds without bank's permission. Borrower will not pay any interest without bank's consent. Borrower should not have shown any tendency of withdrawing the amount in the past. This unsecured loan should not have come from creditors. Based on these, a borrower's unsecured loan can be classified as either quasi-equity or outside liability. Generally, unsecured loan considered as quasi-equity is sourced from family and friends. Let us now look at the calculations of leverage ratios. For calculating leverage ratios, we require to calculate the borrower's own fund and borrowed funds. The borrowed funds or total outside liability, as it is referred in the balance sheet, TOL, shall consist of the following. 1. Bank loan. 2. Unsecured loan, not included as quasi equity. 3. Creditors. 4. Provisions. If you look into the classification of the various sources of fund, you can see that unsecured loan is coming under both borrower's own fund as well as borrowed fund. Let us understand the concept of unsecured loan and principles of quasi-equity classification. Let us look at the net worth and tangible net worth calculations and interpretations from a banker's perspective. For calculating the leverage ratios, the relevant portion of the financial statement is shown in the exhibit on the right. Net worth is calculated as capital plus reserves and surplus plus quasi-equity. From the highlighted cells in the balance sheet shown, 1. As on March 31, 2015, net worth of borrower equals rupees 40 plus 70 plus 30 lakhs equals rupees 140 lakhs. 2. As on March 31, 2016, calculating similarly, the net worth of borrower is INR 212 lakhs. All relevant cells are highlighted for year 2015. The same numbers are added for 2016. The tangible net worth or TNW is given by net worth minus revaluation reserve, minus intangible assets. Please see the cells highlighted in the balance sheet shown. The revaluation reserve is highlighted in red. There are no intangible assets in the balance sheet. 1. As on March 31, 2015, TNW equals rupees 140 minus 10 lakhs equals rupees 130 lakhs. 2. As on March 31, 2016, TNW equals rupees 212 minus 9 lakhs equals rupees 203 lakhs. Note: revaluation reserve is deducted from total reserves to calculate tangible net worth. Let us see the final part of the calculation of leverage ratios. We shall calculate adjusted tangible net worth, ATNW, and TOL here. Let us look at adjusted tangible net worth or ATNW calculations first. ATNW is given by tangible net worth minus investment in group companies minus loans and advances to group companies minus any other unrelated investments. Thus, 1. As on March 31, 2015, ATNW equals rupees 130 minus 10 minus 20 lakhs equals rupees 100 lakhs. 2. As on March 31, 2016, ATNW equals rupees 203 minus 35 minus 28 lakhs equals rupees 140 lakhs. All relevant cells are highlighted for year 2015. The same terms apply for 2016. Total outside liabilities, TOL, is given by unsecured loan minus unsecured loans from friends and family, plus term loans, plus current liability plus bills discounted plus disputed liability out of court. All the figures for 2015 are shown in the balance sheet, highlighted. 1. As on March 31, 2015, TOL equals rupees 20 plus 60 plus 100 plus 50 plus 15 lakhs equals rupees 245 lakhs. As on March 31, 2016, TOL equals rupees 30 plus 70 plus 120 plus 70 plus 15 lakhs equals rupees 305 lakhs. Please note: net unsecured loan equals total unsecured loan, rupees 50 lakhs, minus quasi-equity, rupees 30 lakhs, equals rupees 20 lakhs. Click the next slide button to continue. Now we shall calculate the leverage ratio. Calculation of leverage ratio is given by the formula. Leverage ratio equals total outside liability or TOL divided by adjusted tangible net worth or ATNW. From the calculations in the previous slide, we get for 1. March 2015, TOL equals rupees 245 lakhs and ATNW equals rupees 100 lakhs. Thus leverage ratio equals rupees 245 lakhs divided by 100 lakhs equals 2.45. 2. March 2016, TOL equals rupees 245 lakhs and ATNW equals rupees 140 lakhs. Thus, leverage ratio equals 2.17. Let us look at the interpretation of these findings for the banker. While net profit has gone up, surplus in P&L, the borrowing of the company has also gone up. At the same time, the company has diverted some funds to a group company. However, the increase in AT&W amount shows that diversion is not more than the profit. TOL by AT&W ratio or leverage ratio has also gone down, which may be considered as a good sign. However, though the leverage ratio has improved, the banker must still ask the reason for increased diversion of funds, as this may be the start of wrongdoing and should be discouraged upfront. Please note with caution. In a nutshell, it can be said that the company is using some part of its earned profits in a group company and taking extra loan to fill in the gap. We shall now look at few cases of the leverage ratios observation made by bankers across multiple years. The first ratio is TOL by tangible net worth, and the second ratio is TOL by adjusted tangible net worth or AT&W. The cases are for the various combination of the ratios increasing and decreasing across years. The banker must interpret such observations and ask relevant questions to the borrower. Let us see case 1. TOL by T&W increased across year and TOL by AT&W decreased or remained same. In such case, the interpretation is company is borrowing in higher proportion as compared to infusion of own funds from the promoters, thereby increasing the risk of future repayment capability as well as resulting into reduction of promoters' share in the business. The banker must ask the borrower the following. 1. What are the reasons for increased external borrowing of the company, not supported proportionately by promoters' funds? In case 2, the TOL by T&W ratio has decreased over the years and TOL by AT&W ratio has increased. The interpretation of this is: this clearly indicates diversion of funds. If the other business is not generating enough cash flow, the borrower may not be able to repay. If it provides higher returns than this one, borrower's interest in the business where the financing is happening might go down. Generally, funds are diverted because the other business cannot get funds from banking on its own. The banker must ask the following questions. 1. Ask the borrower reasons for diversion of funds. 2. Ask about the plans for reversal of the diversion. 3. Understand the linkage between the other business and existing. Let us look at another case, where the TOL by T&W is increasing across the years and the TOL by AT&W is also increasing for the corresponding years. The interpretation or implication of the same is company is borrowing in higher proportion as compared to infusion of own funds from the promoters, thereby increasing the risk of future repayment capability as well as resulting into reduction of promoters' share in the business. At the same time, diversion of the fund is also happening to raise all the risks associated with it as discussed in the previous slide. The bankers must ask the following questions to the borrower. 1. What are the reasons for increased borrowing and increased diversion of the fund? 2. Why are funds not raised directly in the other business? The banker needs to understand the stage of the life cycle of the existing business to assess the risk associated with funding such businesses. We have now covered the leverage ratios in details and we will look at the other ratios and their interpretation for bank. Thank you for watching this lecture.